Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Pankaj Matpal, MD, Optimum Money Managers. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyShow@etnow.tv. Good evening, Pankaj, and welcome to the show. And before I start taking our viewers' queries, there's something that we need to discuss, and that is the SIP stoppage ratio that has hit 27-month high. And as per the data that's just come in, we are seeing that 14.3 lakh SIP accounts have been shut down in Feb. And when you talk about SIP stoppage ratio, that's the ratio which means the amount of SIP accounts that have been shut. And the number over here has clearly gone up. If we look at October 2022, which was 0.52, and now in Feb 2023 it is 0.68%. How can we look at this particular number? What does it indicate? What does it mean? How can you read between the lines, Pankaj? Because the markets are sideways. We know that investors are slowly losing confidence, but does that mean that this is going to be there for a very long time, or is just a temporary jerk that we are seeing?
Kavita, good evening. I agree with you. The last sentence, what you said, that is it temporary? So I feel that it will be temporary only, because we have seen whenever the markets are volatile, investors, they get fearful and they cancel their SIPs. And this is the main reason that right now, because we have seen in last 2 years, SIP returns have also become negative in many cases. Many schemes, I mean, that could not deliver positive returns. So that's the reason that investors are a little fearful and disappointed. Another reason at this point of time that there are many other options in fixed income category, whether you talk about the bank FDs or post office schemes, like small saving schemes, which are giving decent returns. So investors, when they compare this with the market linked products, they feel that if they're getting something like 8%, or even small finance banks are delivering good returns on fixed deposit. So considering that fact, investors are finding that those options are more lucrative at this moment. And as the markets are volatile, so they're stopping their SIPs. But if you ask my suggestion or advice, I'll say that investors should stay invested. And if they have invested considering some financial goals, so they should stick to that, because it's not the first time that we are seeing this kind of situation. Many times we have seen that markets did not deliver returns for 2-3 years. But then if you see the 5 years returns or 10 years returns, we always see in equity that is compared to any other asset, these have been better. So there should be patience. Investors should be patient right now.
But then one point that we should also consider, and maybe you can explain further on that. This is the third consecutive month where we've seen SIP discontinuance was above 13 lakh. You know, last February, if we look at 11 lakh accounts were closed. And also, as we all know, the stickiness of SIP flows is dependent a lot on trailing returns, which have been muted. So does that mean that it's just not about being the third consecutive month? We are going to see this phase going on for a couple of months more. And also, if not equity, do you think investors are looking at debt mutual funds? Is the number rising over there? What kind of strategies and what kind of inflow in terms of categories is growing up?
Kavita, see what has happened in India. We have always seen that when we talk about SIPs, it is mostly equity or hybrid SIPs. We don't talk about SIP in debt. And that is the thing, though one reason is that because in equity there's a volatility. And when we suggest investing through SIP, it is because we expect that there will be rupee cost averaging in long term. But as investors, they invest in RD. So they are not investing in RDs for rupee cost averaging, but it is only for saving and compounding returns. So from that perspective, I believe that investors should also include debt mutual funds in their portfolio. And second thing, as at this point of time, if investors, they think that equity is not delivering expected returns, so at least they should switch to debt. Though I'll say that if you are long-term investors, then this is the right time that you accumulate more units in equity funds, so that in long term that will give you better returns. But still, if you feel that your investment horizon is not very long and but you want to invest, then you switch from equity to debt. You continue your SIP and debt schemes, but canceling SIP and not investing or taking other decisions may not be the right thing for your financial goals.
Right, so not the time to stop your SIPs, in fact, time to collect more units. We move on, and the first question that's coming your way, Pankaj, is from Uday. He's investing in mid and small cap funds, and he's in loss since last year. He wants to understand if he can exit these fund categories and also switch to index fund. Time horizon is 10 years for this particular portfolio. We don't have the portfolio details in terms of fund names, but then clearly mid cap and small cap has been a trouble for investors, and as we always recommend and always advise our viewers through a lot of experts also, that this is a category where you need to be invested for more than 5 to 7 years, and just deciding on the basis of 1 year investment time horizon, Pankaj, you think it is right to exit a mid and small cap category, if at all Uday has one?
Kavita, this question is exactly what we are discussing. He's not asking to stop, but at least he also wants that he should exit from the existing scheme and should change to index fund. But thing is that when he invested, he had a clear investment horizon in his mind that he would invest for 10 years. So for 10 years, I'll say that small cap or mid cap or as a category, mid cap, mid and small cap is a good category. So he should stay invested, provided his choice of scheme is correct. He has not mentioned the name of schemes, so I can't comment on that. But as a category, whether it's a separately mid cap and small cap, or it is a mid and small cap category, so he should stay invested. Now, if he wants to add an index fund, so Nifty 50 index fund can be added to the portfolio. It can be an additional SIP, but just by looking the past 2 years returns, I think that he should not change his mind. Because overall market is down, and that is why the performance of schemes where he has invested, that is down. So I think that he should continue. And in addition to that, as he asked for the index fund, that can be an additional fund in his portfolio.
We move on. The next question is from Pankaj, and okay, he wants you to suggest some debt mutual funds or other funds, other category funds where he can have the advantage of rising interest rate scenarios, and he wants to invest almost 5 lakh lump sum.
Yeah, say for 5 lakh lump sum and the investment horizon is not very long. Suppose you want to invest for 3 years, 5 years, something like this. At this moment, I'll suggest that low duration fund or short duration fund, because in debt funds we have different categories, and based on the maturity of the underlying assets, these are categorized. So here, short-term fund like ICICI Prudential short-term fund or Aditya Birla Sun Life short-term fund, it can be a right choice. He can invest in these schemes. Or if he wants to take a little bit more risk and he wants to add equity to, then in that case, we have conservative hybrid funds as well. But if the question is specific to debt fund, in such case, low duration fund like Kotak low duration or SBI Magnum low duration or short-term fund, as I mentioned earlier, can be considered.
All right, tell us something, how important, okay, if it is need-based that you want to balance out your portfolio, one can really park their money in a debt mutual fund. But what if you don't really need it, but you want to take advantage of the rising interest rate scenario? Is it important for one to, in spite of not having the place or not having the requirement, should give space to a debt mutual fund just because the interest rates are looking attractive right now?
See, if you wanted to invest in fixed deposit or small saving schemes, so as an alternative, you have this debt-oriented mutual funds as well, which have potential to deliver little better returns compared to your fixed deposit or small saving schemes. So definitely, you should consider at this point of time. But if your goals are long term, I'll say still you should invest more in equity because you are getting uh, uh, opportunity to invest at a discounted price. So for long term goal, I'll say that you should stick to equity funds only. But as we say that you should maintain asset allocation. So for that purpose, definitely at this point of time, debt oriented mutual funds are looking better. And for next 2-3 years, I expect decent returns from debt-oriented mutual funds.
All right, let's move on to our next viewer, and she is Samira Shaw, and she wants to create a corpus of 5 crores for her child, and her daughter is 2 years old. She wants to invest to secure her future. She can invest 20 to 30,000 per month for 20 to 30 years.
See, Kavita, there's a difference between 20 and 30,000 and 20 years and 30 years. There's a big difference. But if I do simple math, if she invests 30,000 per month and I assume 12% CAGR on that, so in 30 years, she can have around 8 crore rupees or a little more than that. Or if she invests for 20 years, then it will be something like 2 crore 75 lakh. So now if she wants to invest 30,000 and also she wants to accumulate 5 crore rupees in 20 years only. So my suggestion is that she should opt for step up SIP. So she should increase by 10%, 8 to 10% every year. In that case, in 20 years itself, she can accumulate 5 crore rupees. Otherwise, in 30 years, she can expect more than that, as I mentioned earlier.
What are the funds that you're recommending?
Yeah, because the long-term investment horizon. So ICICI Prudential Flexi Cap Fund, Aditya Birla Sun Life Multi Cap Fund, Motilal Oswal Mid Cap, and also Axis Small Cap Fund. So these 4 funds she can add to her portfolio.
All right, we move on to our last question, and that is from Aparna. Aparna wants to understand, in the current market scenario, can she have a fixed income instrument considering better investment avenues as compared to equity mutual funds? Time horizon that she is looking for is actually 3 to 5 years. And for that, she wants to consider something which is safer and better than equity, which is a fixed income. But what do you suggest?
Sure, Kavita. See, at this point of time, definitely for the horizon of 3 to 5 years, I'll not suggest that one should go for pure equity funds. But yeah, one choice is debt-oriented fund. As I mentioned earlier, also that short-term debt funds can be considered. But because she had mentioned 3 to 5 years, so conservative hybrid funds can also be added to the portfolio. So that can be choice. So in debt-oriented funds, again, ICICI Prudential short-term fund or Aditya Birla Sun Life short-term funds. These can be good choice. But if you want a little allocation in equity, because these conservative hybrid funds can invest 10% to 25% of the total AUM in equity or up to 90% in debt also, any point of time. So if she wants to take little risk of equity here, for in the expectation of little better returns, then it can be SBI Magnum Conservative Hybrid Fund can be considered in this case, or Kotak Debt Hybrid Fund.
All right. On that note, thank you so much, Pankaj, for being on the show and helping our viewers with their financial portfolio. And it's a wrap on the Money Show as well. But then